Audio article Property Right Limitations Within the Fiat Monetary System of the European Union by Lauris Bočs. Preface. Continuing the usual article publication process, an audio article has been made accompanying the published article Property Right Limitations Within the Fiat Monetary System of the European Union, which was published in the indexed conference proceedings of the 4th International Multidisciplinary Scientific Conference on Social Sciences and Arts, SGEM 2017. Author of the published article and this audio article is Lauris Bočs. It is suggested that every listener listens also to previously created audio articles which are available on the internet address files.fm/Lauris Bočs, that is in one word Lauris B-O-C-S. Also, any figures, pictures or tables used in any of the published written articles can be seen in the aforementioned website and the uploaded scanned articles themselves. Also, it would be appreciated to receive viewpoints, criticism and suggestions via email to the email address lauris.bots@inbox.lv. The motto of the audio article has been chosen to be a quote by the English chemist Frederick Soddy. Energy, someone may say, is a mere abstraction, a mere term, not a real thing, as you will. In this, as in many another aspects, it is like an abstraction no one would deny reality to, and that abstraction is wealth. Wealth is the power of purchasing, as energy is the power of working. I cannot show you energy, only its effect. Abstraction or not, energy is as real as wealth. I'm not sure that there are not two aspects of the same thing. The audio article has been finished for publication on March 31st, 2017. End of the preface. Property right limitations within the fiat monetary system of the European Union. Magister of Jurisprudence Lauris Bočs, Riga Stradiņš University, Latvia. Abstract. In 2016, the European Union, EU, became centrally supervised regarding a unified regulation of the so-called banking union, making also the area of the euro currency a monetary union with a common approach to integrated policy implementation in a non-federalized union. Since modern fiat, i.e. non-backed money creation within the EU banking system has not been affected by any legal reforms, the author has done legal research on its meaning for property rights of EU residents, especially in light of recent events such as the so-called Brexit, which represents a regional divergence. The aim is to determine the legal framework and associated problems using descriptive, logical and deductive methodology within a doctrinal analysis for the enforcement of EU financial law relating to monetary stability, and to give a simple assessment of possible solutions, especially in relation to monetary value protection capabilities. The author suggests to allow expressis verbis member states to hedge inflation risks by way of an EU directive to still respect regional economic differences. Keywords: European Union, fiat money, property rights. Introduction. In 2016, the European Union, EU, finished the establishment of the so-called banking union, which means that at least all euro currency countries in the EU have their banks supervised under a centralized European Central Bank (ECB) mechanism. The British referendum in 2016 for the United Kingdom to stop its membership in the EU because of inter alia economic reasons can be considered as a legal warning call to the EU relating to forceful policy integration in EU members with unresolved risks. Since integrated economic relations between EU member states are still highly relevant and private banking practices relating to credit creation will continue, the author has done legal research relating to the contemporary fiat money system. While economists usually understand that bank credit increases the overall money supply, legal researchers in Europe have not done any extensive research relating to the fact that private banks still create the biggest part of the money supply ex nihilo, i.e. out of nothing. And the aim of the research is to determine the normative regulations and associated problems for the enforcement of EU law within the EU's financial sector for unified monetary stability, and to give an assessment of possible solutions, especially in relation to money, property and asset value protection capabilities within the EU states nationally, since membership in the EU is not the crucial determining factor for a European country to be economically integrated into the EU economy, like for instance in the case of Switzerland. Using descriptive, logical and deductive methodology within a doctrinal analysis, the normative supervision of EU monetary policy is evaluated in relation to the hypothesis that the centralized supervision of a fiat money system centralizes volatility into a systemic risk for EU asset markets. This legal research paper relates also to the Journal of Economic Literature, GEL codes K11, Property Law, and K22, Business and Securities Law. After publication, the paper will be recorded and made available on the internet for listening as an audio article and with a Creative Commons license, and also a video with the paper's title made for additional commentary on the video sharing website YouTube. The author concludes that sophisticated money and asset protection can be achieved within the existing national legal frameworks within EU states, since fiat money is legal tender according to law and relating to so-called seigniorage rights of legal tender creation within every constitutional jurisdiction. That means that EU monetary policy through the ECB relating to inflation management must not be the only mechanism for the protection of the purchasing power of money and also asset values within the EU member states. Therefore, the author suggests to implement hedge mechanisms within EU member states by way of EU directive, providing for possible tax credits, social benefits, or other measures of stable value as compensating mechanisms for property right violations due to the decrease of purchasing power of EU legal tender. Theoretical implications of fiat money. The EU has established a union for economic and monetary policies with the euro as the official currency according to Section 4 of Article 3 of the Treaty on EU. The mechanism for the issue of currency is under the ECB's auspices according to inter alia Article 128 of the Treaty on the Functioning of the EU. In the field of economics, currency as banknotes and coins and money as a payment and value denomination tool are fairly differentiated terms, since several things can be money, like for instance credit in the form of bank loans, which is succinctly described by an ECB article. Banks' liquid deposit liabilities constitute the core of broad monetary aggregates, and banks thus play a leading role in the supply of broad money. This means that currency is just a small part of the total money supply, and the biggest part is provided by private commercial banking activities through lending operations. Legal researchers in Europe have not done extensive and widely publicized research on the topic of money, yet fiat, Latin for let it be, money is created by legal acts of sovereign jurisdictions, making the chosen object legal tender by decision without any intrinsic value backing it. The rights to so-called seigniorage, i.e. creating legal tender and profiting from it, are well understood to be legally controllable, since they can be used for strengthening economic development, which the ECB does for inflation management in the EU since its inception. Therefore, the legal right of the sovereign for money creation must be legally protected and used in accordance with the interests of society. Economists have long-standing debates relating to the actual implications of bank lending on systemic money levels, yet the accounting procedures for bank loans clearly establish that bank deposits are being used as payment tools, falling under definitions for the term money. So lending operations of banks create in their balance sheets assets for the debtor and liabilities for themselves by mere input of numbers in an accounting ledger, see Figure 1. Yet those liabilities become money by being directly usable for payments through non-cash transactions via banking accounts, which are representations of the particular bank's bookkeeping accounts. Furthermore, the created deposit accounts are mostly safeguarded by public authorities to a certain limit, which means that private bank-created money is insured by the state and de facto establishing money that is as good as currency. Figure 1. Representation of a bank's double-entry accounting operation in an accounting ledger. Practical implications of fiat money. This paper has been made for the 2017 International Scientific Conference (SGEM) Scientific Conference on Social Sciences and Arts in Vienna, and the author points out that Austria has historic and contemporary researchers with established backgrounds relating to money analysis. For instance, Ludwig von Mises and Friedrich Hayek both have described the theoretical implications of the banking system creating additional credit and increasing the money supply without any government intervention, leading to perpetual cycles for economic growth. The author points out that banking operations have been under scrutiny ever since safekeeping of currency became a separate niche of financial intermediation, yet the essential research has only begun in the 20th century due to the scope and impact of banking operations. In modern times, Professor Dr. Franz Hörmann, for instance, has concluded that bank lending operations have an inherent tendency to perpetuate overall debt levels because of interest payments being additional claims against the principal sums. As German economics professor Richard Werner has eloquently described in a series of publications, modern money creation rests mainly within the private banking sector, and its control under the premises of the economic theories of fractional reserve and financial intermediation banking is impossible without addressing the issue of inflationary lending activities through bank accounting operations. As the money supply comes many times through lending activities, legal scholars have to consider that income for a person's work becomes private property, yet the legislative acts within the EU do not protect that property's worth, i.e. protect against inflation. Traditionally, the topic of money has been associated with economic issues, yet the legal tender aspect makes it an object of interest for legal research as well, especially in terms of its purchasing power, which commonly deteriorates due to inflation. If people mostly earn so-called active incomes, i.e. incomes for their active labor, the biggest concern is that time is spent, but earned income loses its value because of inflation. For example, if somebody works a full workday and for its pay can buy on one day a certain amount of goods, but the next day only half because everything is twice as expensive, it means that the person would need to work twice as much only to buy the same amount of goods as before. Even though it seems straightforward, the author notes that firstly, there is no established legal need for inflation. Secondly, protection of property rights of people who earn their income by active work have not been addressed in any political, legislative, or judicial act within the EU as far as can be found. This makes the topic of money highly important for EU legal researchers, since the centralization of banking supervision can seem as enough for monetary stability. Essentially, EU residents have to trust that, for instance, public debt does not become too much of a burden and does not affect growth within economic processes of a particular jurisdiction, since EU governments, according to the so-called Maastricht criteria, pledged to maintain budget deficits till 3% and sovereign debt till 60%, for instance. Additionally, existing research suggests also that for such criteria to be effectively applied, international financial institutions and their members have to be competent to ensure impartial judgments for control and procedural fairness. It is important to remember that assumptions about political consistency, institutional congruence, and the competency of personnel supervising financial operations are actually a leading factor for reform efficiency, since the anthropological and sociological premises need to be established mostly on a consensus basis within the social sciences. As can be seen in Figure 2, for instance, the average sovereign debt amount in EU and Euro area countries is considerably exceeding the Maastricht criteria, so the legal interest would be in applying public debt limitations consistently to avoid excessive inflation risks, and in case of political incongruence, as is the case, to apply any possible risk management de lege ferenda, i.e. protective future legislation initiatives. Figure 2. General government gross debt average in all EU and Euro area countries. Quarterly data % for third quarter of 2016. Possibilities for EU fiat monetary stability. This paper has shown that money is anything made as legal tender by acts of the legislature. Additionally, the paper has demonstrated that there is no legislative or judicial body of work in the EU for the protection of money's purchasing power, even though in jurisprudence it is self-evident to consider it as property rights of those who earn money, since in the EU it does not matter what money's nominal says but what purchasing capacity it possesses. Therefore, the author uses a logical comparison with EU electronic money regulation as a basis for conclusions and suggestions. According to EU Electronic Money Regulation, Article 1, 2 and 14 of EU Directive 2009/110/EC of 16th September 2009, the issue of electronic money means that monetary claims are being digitally stored and used as payment tools without the physical transfer of currency, for instance, but it has to be understood that credit institutions have to be prudential, and the EU will make needed amendments in relation to inter alia inflation risks. Such legal considerations could be applied to any type of money regulation that is not currency, because the same economic factors are at work for all payment transactions and also storage objects of monetary value. The system of EU directive transposition, according to Article 288 of the Treaty on the Functioning of the EU, allows national authorities the choice of form and methods to achieve the aims of EU directives. Considering the political and economic issues in 2016 of the EU relating to the so-called Brexit, Greek sovereign debt problems, trade and investment negotiations with the United States of America, etc., the author proposes the implementation of an EU directive which fundamentally allows member states to use national means for limited and aimed liquid fund creation in order to allow some form of liquidity to be dispersed without private profit motives, protect purchasing power of incomes as property rights, and to receive feedback for de lege ferenda, i.e. future regulation needs for money in general in an EU-wide digital single market economy. Sophisticated money and asset protection can be achieved within existing national legal frameworks within EU states, because fiat money is legal tender according to law and relating to so-called seigniorage rights of legal tender creation. The working population who receives active incomes for their time spent at work has to be legally protected from purchasing power losses of their wages, salaries, etc. as property rights. Therefore, the possible implementation of an EU directive that calls for tax credits, public service claims, or any other benefits that public authorities are capable of providing to the public outside of the banking sector could create an effective hedge mechanism against monetary inflation, because public debt and private bank money creation is considerably lacking consistent discipline. Need for future research regarding fiat money. This paper has been made as a consolidated representation of an already established body of research with the added realm of legal issues relating to money's purchasing power as property rights. Since that is an interdisciplinary topic, the contemporary congruence of research should be a priority within legal research. The author has established a foundation for financial rights research in Latvia and hopes that this paper can initiate a foundational analysis for an EU legal research doctrine relating to the fiat money system of the EU, since its proper and democratic functioning is in the best interests of all EU members and their residents. Since economists develop theories relating to money supply sources, it means that scholars of law need to actually be competent to evaluate them for their merits within the political implementation options of new regulation. The author has often recognized the lacking understanding of legal scholars and actually of legal counselors within legislative and executive institutions as a reason for policy difficulties and short-sighted decisions for economic and political short-term solutions. Therefore, the author points out the corpus of publications and presentations from Professor Richard Werner on the internet as one of the most appropriate threads for legal scholars in the EU who are looking to initiate their own research in order to further the cause of long-term development within financial law and legal tender creation in sovereign jurisdictions. Conclusion. According to the research, the author established these theses. 1. The Treaty on the Functioning of the EU has created a central but legally unsophisticated money creation mechanism by which money's purchasing power and asset protection is not publicly protected, and only individual solutions of EU residents within their national jurisdictions can protect them against inflation, i.e. loss of money's purchasing power, for instance. 2. Protection against inflation creates a legal trust when it is effective, and since the public monetary policy measures should be democratic, a legal obligation for asset protection law procedures could create a homogeneous systemic EU property right protection policy with the practical effectiveness of regional member state legal mobility according to regional economic needs and options. 3. Property right protection can be legally eased with a unified code of conduct for use in member state legal practice, since member states have the mechanisms mostly in place already for property protection that could be used for the purchasing power of money as well. 4. The author suggests an option of establishing a fiat money system within the EU by directive, according to which member states need to establish hedge mechanisms against inflation by, for instance, tax credits, public service benefits, or other fixed value measurement options. 5. The established freedoms of movement for human resources, capital, goods, and services in the EU means that economic integration will be a priori related to a safe money system relating to not just its circulation infrastructure, but also to its value-conserving attributes, which becomes the single biggest legal need for legal tender in general, so legal scholars in the EU have to specifically address fiat money issues, particularly in the EU digital single market of the 21st century. 6. The author suggests that legal research for fiat money has to start by establishing clear criteria according to established evaluation criteria of property right protection inter alia according to needs in a democratic society, efficacy, and proportionality. Acknowledgement. The author would like to acknowledge Doctor of Jurisprudence Jānis Grasis and Doctor of Jurisprudence Andrejs Vilks for their work and guidance during the author's doctorate studies at the Riga Stradiņš University's law faculty, since this paper represents a consolidated body of pioneering research relating to Latvian legal studies for financial and monetary legislation, which could enable Latvian and also EU legislation efforts for sustainable financial development. References. End of the audio article.